What's up, people? Welcome back to Invest with T Claus. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, Neo, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. So here we go again, another full transparency update. First one of 2022. If you're new here, every quarter I go through an update on the holdings in my Robinhood account, basically covering what I bought or sold and the why behind it. For those of you who have been around for a while, you have no doubt noticed that I no longer provide a weekly update on the gains or losses. The main reason being that one, it was taking time away from the meaningful content I could be sharing with you, and two, the week-to-week action in the grand scheme of things is somewhat irrelevant. My goal, as always, is to get you thinking longer term in order to better navigate through the constant short-term noise and allowing you to identify themes within the marketplace and crypto. So with that in mind, let's dive into today's content. I do want to take a little bit of time and touch on Tesla's Q1 delivery that was just released. We'll then look at my account performance versus the broader market so far in 2022, then discuss the adjustments I've made in Q1 and why, and close out with how I'm doing against the predictions that I laid out here in this video in January for the full 2022 year. As always, this is not to be taken as financial advice. I am not a financial advisor. This is my personal approach to investing and the thought process behind it. That said, I'd recommend watching all the way through so you don't miss out on any pertinent information I'll be sharing with you. Drop the video an early like if you haven't already, and hit that subscribe button. Those are two easy ways to show your support to your channel and help it grow if you appreciate the content. All right, let's get into it. Okay, so starting with Tesla, Q1 delivery numbers were released along with a note from Adam Jonas from Morgan Stanley. I haven't covered Tesla yet this year, so I thought between that and stock split news, it would be good to briefly touch on those two topics. This was another all-time delivery quarter for Tesla, no surprise there, with deliveries of 310,048 vehicles. Keep in mind that this is pre-opening of Giga Berlin and Giga Texas, right? So there are two new factories. Tesla has also announced the date for their Q1 earnings call, which will be on Wednesday, April 20th at 4:30 p.m. Central Time or 5:30 p.m. Eastern Time. Though I don't post as regularly about Tesla, it is by far, and I mean by far, my highest conviction position. They've won the decade in my opinion. People and analysts alike are starting to wake up to this reality. They're literally 5 to 10 years ahead of the closest competitor when it comes to manufacturing scalability and technology. I just want to share with you 3 key points that Adam made in his note to a client. And for context, he has a $1,300 price target with a buy rating. You can see his profile here. The man is accomplished. The funny thing is, he used to be a skeptic, right? Until he dug deeper. His awareness level is reflected in his rating and price target as time went on. But anyways, the first point that I want to share with you that he makes, and I quote, "The TAM for global storage market is everywhere energy is generated, everywhere it is used, everything that moves. Is there a bigger TAM than this?" And for the record, TAM is total addressable market. The second point that he makes, Tesla combines pricing power, supply chain visibility, capital access, and a business model focused on improving energy efficiency. Point number 3 that he makes, and I quote, "More work to do here, but if we had to pick a round number of how much must be spent through 2040 to re-architect the upstream supply chain, midstream manufacturing, refining, and downstream infrastructure for the global renewable battery ecosystem, it would be on the order of $50 trillion. That is a ridiculous number, okay? So what does this all mean? Simply put, it basically means that Tesla is one of those companies that stands to benefit the most from the switch to renewable energy over the next 20 years. The other important point that people tend to miss is that electric cars is just one of the many ways that Tesla packages and distribute their energy, AI, and software solutions. The video playing right now that you're looking at is a fly-through they did in Giga Berlin. The manufacturing ability itself is on a completely different level. Tesla is also one of the most, if not the most vertically integrated company in the world, which is why while other automakers' sales are declining, Tesla is able to successfully navigate this challenging supply chain environment and grow. The bottom line is this: if you believe in a renewable and sustainable future, but you're not investing in Tesla, which is helping drive that future forward in more ways than one, you'll be kicking yourself in a few years. So one of the most common criticisms that Tesla gets is that the stock price is just too high. And that's, kind of a barrier of entry. Well, now with the upcoming stock split, if I'm right, we're looking at either a 10-to-1 stock split like they did with SpaceX, so mirroring that, or they may go the 20-to-1 stock split similar to what Amazon and Google are doing later this year. And so ultimately what we'll be looking at for a post-split stock price is going to be in the 50 to 100-ish price range. We'll find out the date for a split at the next annual shareholder meeting. My guess is that we get the date for that meeting during the earnings call later this month. And the stock split itself actually happens sometimes this summer or in Q3 this year. Either way, when we have the dates, I'll share it with everybody on either my Twitter account or I'll do a video on it. At the end of the day, the best thing to do with a Tesla stock, honestly, is to buy it and forget it, check back in 10 years, and you'll be closer to being able to retire earlier than if you had not bought, right? But anyways, I could literally go on forever here, but we don't have all day. So let's move on to the transparency update. All right, so on with the numbers for Q1 2022. As a reminder, I closed 2021 with an account value of $102,508.92. This was good for a total yearly gain of 42.80% or $30,723.35. So the question is, how bad was the damage during Q1? Well, this is where the account currently sits as of April 2nd. Starting with a weekly view, the account gained 14.50% or $9,280.96. For the month of March, the account climbed by 23.27% for the equivalent of $13,836.76. And for the first 3 months of the year, the account is still down 19.19% or $17,388.15. The lowest point of the quarter was reached here on March 14th. That's when I came out and called the bottom, right? If you remember that. The account was worth $41,801.61 at the time for a face-melting decline of 53.88%. That hurts. But all things considered, it's actually okay because we're now on the path to recovery and climbing actually a bit faster since I bought the dip in many instances. The current account value sits at $73,324.12. And if we take it a step further, you can actually push this to a full year. And on a year-over-year basis, I'm currently up 2.02%. By comparison, the S&P 500 is down 4.62% year-to-date, the Dow Jones is down 4.18% year-to-date, and the Nasdaq is down 8.84% year-to-date. Both the S&P and Dow Jones corrected by a little over 10% before recovering to the levels I just mentioned, with the Nasdaq getting hit the hardest with an 18.90% correction before recovering to the current level. So what's the verdict for Q1? Well, I'm currently underperforming the broad market indices, but outperforming myself from a year ago. So I think it balances out, right? I'm gonna go with that. Now let's talk about the adjustments I've made for this quarter. I trimmed Tesla further right as we came into the new year while it was still over $1,000. I sold NEO but bought back post-crash, which helped lower my average cost. I've increased Virgin Galactic further from 900 shares to 1,250 shares, increased my charge point from 500 shares to 950 shares, increased Hive blockchain from 500 shares to 1,500 shares, moved my Bitcoin and Doge off platform, and kept my Ethereum virtually the same. So why did I do that? Well, let's start with moving Bitcoin and Doge. The decision here came as I want to over time decouple my crypto and stock portfolio. Now that Robinhood has added the crypto wallet option, it was a good way to test it out and get the process started. For Ethereum, I kept most of it here, the main reason being that I do not want to get tempted to invest too heavily into NFTs, while I'm still learning and educating myself on what qualities make for a successful NFT project. I'll share my thoughts on that in a different video. For Virgin Galactic, well, that's pretty straightforward. The opportunity to average down while at these low level is just too good to pass up, and I've been talking about this for a while, right? When you consider that we will likely return near the previous all-time high as flight resumes later this year, holding something like, call it 500 additional shares could net $25,000 in profit at that point. The other benefit, of course, is reducing my cost and turning positive sooner on the year. Hive blockchain, it's the cheapest and most undervalued stock in my portfolio. As Bitcoin and Ethereum climb towards their new all-time high in the second half of this year, so will Hive. Remember that I'm using Hive as a way to scale up the portfolio faster. Last but not least is ChargePoint. The goal here is to reach 1,000 shares minimum. And coming into the new year, it was pretty obvious that we were going to trend down, right? So it was the perfect opportunity to add more. While the market is still undervaluing, how quickly EV adoption happens from here. Again, these prices were a fantastic opportunity to average down and reach my share count goals sooner. I've said this before, but it's worth repeating again and again. Fortunes are built in stagnant and or down markets, right? Endure the short-term pain so that you can capitalize on the long-term gains, especially when the companies you're invested in have visible and quantifiable improving fundamentals. So where do we go from here? If you watched my last transparency update, I gave you the blueprint for the narratives that will drive the market this year. I then, in additional videos, over the course of our time together, explained to you why Q1 would be downhill, with bottom hitting as we near the close of Q1. All that has now come to pass and almost right on cue, right? So where does that put us now in this cycle? Well, here's my take. Over the next couple of weeks, we're going to march cautiously higher as institutional investors have already been putting money to work but aren't going all in just yet. So the question naturally is, well, what are they waiting for? Well, there's tax season to wrap up in a couple of weeks here. First rate hikes to go into effect. Next round of corporate earnings, a bit more clarity on the peace talk with Russia and Ukraine, and probably parsing through economic data to see if the economy is still expanding or starting to slow down a bit with the rate hikes going into effect soon here. Not to mention the one getting the most attention right now, recession risk, and that's because the 2 and 10-year bond yield curve inverted just briefly this week. There's a lot that I could go into here, but in the interest of time, I'll only make this statement for now. Even if we were to hit a recession based on historical data, it would not hit until Q4 this year at the earliest. That gives us plenty of time to hit new record highs both at the indices level and in the individual stocks that I focus on. Lots going on still, but this is why you follow this channel, to get a simple distilled down view of the market and dynamics at play. And on that note, I'll leave it here for today. Congratulations to you on surviving Q1, likely the most challenging part of this year from an overall decline standpoint. Don't forget to drop this video a like if it helped you gain a new perspective, and share with others who you think could also benefit from it. For my newcomers, subscribe and don't forget to ring the notification bell so that you too can stay in the know. I'll be back on Sunday and as time allows during the week here and there. Thank you for watching, stay humble, hustle hard, and I'll see you in the next one.